We are a manufacturing business, right? You never heard that. We are a manufacturing business. We're not a service business. We manufacture hours of pest control service. And what goes into that? Gross margin, what is it? For anybody who's been to business school or taken an accounting course, it's pretty easy to talk about gross margin. The formula is basically your revenue minus your cost of goods sold expressed as a percentage, right? So if I have $100 of revenue and I have $50 of cost of goods sold, then I have $50 gross profit, which is a 50% gross margin. Okay. Now, seems pretty easy. However, if your chart of accounts doesn't line up with our chart of accounts, you can't compare your data to this. Okay. So the way that I look at the pest control industry, we are a service industry, but when you look at a P&L, your P&L, we are a manufacturing business, right? You never heard that. That we are a manufacturing business. We're not a service business. We manufacture hours of pest control service. And what goes into that? What goes into that are the raw materials. The raw materials are your chemicals, your direct labor, and your vehicles, and anything else that happens on the road, technician uniforms. There are other things that you can argue that go into there, like your liability insurance, because that's based on, that rises and falls with revenue levels. Okay. So the first thing you have to do is agree with me on that in order to look at this data. Now, I will tell you, some people will say, well, your gross margins are too high, and I'll look at their data, and that's because they've put managers and supervisors in cost of goods sold. I don't do that. There is a good accounting theoretical argument to do that, but there is also a good accounting theoretical argument not to do it. I like to keep it pure. I want to know what it costs me to manufacture an hour of service. So that's the way that works. So gross margin is an extremely important formula. And just so that you understand how that works, we said $100 minus 50 equals 50, a 50% gross margin. The reason that that's important, and I would argue is probably the single most important KPI that a pest control company can look at, is because it determines your break even. So anybody who's taken an accounting or finance or even operations course and understands break even analysis, and that's usually used for manufacturing operations, if you apply that to this, we can say that if I have a 50% gross margin and all my fixed costs are $100,000 a month, my break-even point would be $200,000. After that $200,000, if I can hold my fixed cost constant, I will be making money at a rate of 50 cents on the dollar. Okay? That's extremely powerful, because when we get new clients that are just on the cusp of break even, and then we push them way over break even, if I double my revenue, my profit doesn't double. It goes up exponentially, which also works against us because we get new clients who never paid taxes before, and now they have to pay all these taxes and they're mad at us. Okay. So that's the cost of good. That's why gross margin is so important, because if you can understand what that margin is, you can understand what your fixed costs are. Here are the numbers. So I said 50%. And the reason I used 50% is so that we could do that calculation in our head. But here's how they pan out. In the Southeast, it's 54.6%. In the West, it's 55%. Midwest, 57.84%. Mid-Atlantic, 58.32%. And again, Mid-Atlantic has the fewest data points. So probably not the number that I'm really, I don't know whether that's right or not, but Northeast, you're right there as well. And that has quite a few data points. And then Southwest, 56.9. Anybody ever look at our 2019 study? What was anybody remember the gross margins? It was like 52 or 52 and change. So our gross margins have gone up. If you listen to our podcast, we were banging the table, raise your prices, you get a free price increase. And the reason that you had to raise it significantly was when COVID happened and the impending inflation that happened after that peaked out at 9%, that was like the general basket of consumer goods and services. That wasn't labor. Labor shot way up. So you had to raise your prices, right? You had to raise them in a big way. And so what we did is we raised our prices, which affects gross margin, but we also became more efficient. And I would argue that a lot of the tools that you see out on the floor have made you more efficient so that you could have more efficient routes. There's a couple ways that you can affect gross margin. There's actually a few, right? What I could do is I could reduce my costs by saying, you know what, my technicians make too much money and take money away from them. That won't go over real well, right? But the other thing that you can do is you can raise your prices, but maybe competitive pressures won't allow you to raise them too much. The final thing that you could do is you can improve your routes, right? Route management. So when I worked at Deloitte, one of the worst things that I had to do was fill out a timesheet. And the reason is because I had to account for my time. Accountability is a horrible thing, right? So I had to charge clients all day. And their goal for me was to be 90% utilized, right? Meaning that if I put in 10 hours, I had to charge 9, right? That's a perfect way to look at our technicians, right? How many hours were they punched in? And I don't care whether you're using 7i or not. You've got to keep time records, right? How many hours are we punched in and how many hours are we on the job and what's that ratio? Okay. And if you can increase that ratio, you're going to increase your route efficiency, thereby lowering your direct cost and increasing your gross margin. It's the single most powerful thing that you can do.